Many people believe Warren Buffett is the best investor of our time. His company, Berkshire Hathaway, performs incredibly well every year. Each year, Buffett writes a letter to his shareholders about how well the company's stock is doing. Since he became the leader in 1965, the average annual return is 20.1%. That's way higher than the market's average of around 10 to 12%. During this time, Berkshire's total return has been an amazing 3.6 million compared to the S&P 500's 30,000. These are just some of the reasons why people listen when Mr. Buffett gives advice. He says that stocks are safe for the long run, but they can be risky in the short term. Watch this video until the end to get 6 secret lessons. In this video, we will discuss some of Warren Buffett's ideas and advice that relates to the economic issues we could face in 2024. Before we do that, we need to understand how serious these issues could be. We need to think about what the economy might look like. According to Jim Mastro, who oversees strategies for over $130 billion in mutual funds and ETFs, the U.S. could be moving from a time of plenty to a time of scarcity. If you're enjoying this video and want to learn more, don't forget to subscribe to my channel and hit the bell icon. There have been rumors of a recession for over a year, and they're not going away. Even though our economy is strong and unemployment is low, a recent article in Forbes predicted a mild recession in late 2023 or 2024. Do you remember what happened after the big financial crisis? The average American became richer. 2 big things happened. First, the Federal Reserve, the Fed, kept interest rates very low to protect the economy. This started during the financial crisis of 2008-2009. The low interest rates continued with a brief pause when the Fed cut rates to offset the impact of Trump's tariffs and stepped up these efforts during the pandemic. From 2010 to early 2022, the Fed funds rate was above 1% for only about 2.5 years. The rest of the time, it was close to zero. The second big thing was a big increase in federal spending. From 2012 to 2019, federal spending went up a lot during the COVID outbreak and its aftermath. It increased from $4.45 trillion in 2019 to $6.82 trillion in 2021. That's a 53% increase, or nearly $2.4 trillion in just 2 years. Even though spending has gone down a bit, it's still a lot higher than before the pandemic. The budget for 2023 is $6.35 trillion, which is only 7% less than the highest amount 2 years ago. Whether you're a beginner or an expert, you'll find something useful and entertaining here. Subscribe and become part of the family. For the past decade, these super low interest rates and high government spending have brought a lot of money into the economy. But now that's over, and people are worried. You could argue that the economy in 2023 taught us a valuable lesson. Despite predictions of slow growth or even a recession because of inflation, America surprised many by growing at a rate of about 2% even as inflation went down. But recessions are more than just slow growth. They often also mean more people lose their jobs. There are fewer jobs available, and the government has to give more help, like stimulus payments and unemployment benefits. These factors make investors wonder if it's better to save every dollar they earn or to invest for the future. In a recession, stock values often go down. This can be a problem for people who already have investments. But what if I told you it's actually the best time to make money? Here's how Warren Buffett explains it. With interest rates rising, it's important to take into consideration how this could affect your investments. Higher interest rates tend to make borrowing more expensive, which can slow economic growth and thus impact the stock market. However, not all sectors are negatively impacted by rising rates. For instance, financial institutions like banks often benefit from higher interest rates, as they can charge more for loans. Therefore, diversifying your portfolio to include stocks from different sectors can be a good strategy to manage the risks associated with rising interest rates. Additionally, investing in companies with strong financial health that have low debt and strong cash flows can also help protect your portfolio. These companies are more likely to withstand the negative impacts of rising interest rates. Moreover, consider investing in real assets like real estate, gold, and other commodities. These types of investments often perform well during periods of high inflation and can serve as a hedge against rising interest rates. Lastly, don't forget about bonds. While existing bonds may decrease in value with rising interest rates, new bonds will be issued at these higher rates. Therefore, holding a diversified portfolio that includes a mix of both short-term and long-term bonds can also help navigate this environment. To summarize, while rising interest rates can pose challenges, they also bring opportunities. The key is to stay informed, diversify your portfolio, and make adjustments as necessary to adapt to the changing market conditions. Several factors can potentially benefit from rising interest rates. 1. Financial sector. Banks and other financial institutions often benefit from higher interest rates, as they earn more from the spread between what they charge on loans and pay on deposits. 2. Insurance companies. Insurance companies invest the premiums they collect from customers in bonds and other interest-earning assets. When interest rates rise, their investment income can increase. 3. Consumer discretionary. As interest rates rise, it's usually a sign of a strong economy. In such cases, consumers are more willing to spend, benefiting companies in the consumer discretionary sector. 4. Technology sector. Some technology companies with large cash reserves can earn more interest income when rates rise. 5. Real estate investment trusts, REITs. Some types of REITs, particularly those involved in commercial real estate, can benefit as they may be able to charge higher rents in an environment of rising interest rates. Remember, the impact of interest rates on sectors can vary greatly and can be influenced by a multitude of other factors. Always do thorough research or consult with a financial advisor before making investment decisions. While navigating the economic terrain in 2024 with high interest rates can be challenging, there are alternative solutions and suggestions to consider. 1. Diversify your investments. Instead of solely relying on stocks, consider diversifying your investment portfolio. This can include investing in bonds, real estate, commodities, or even alternative investments such as cryptocurrencies. Diversification can help mitigate the impact of rising interest rates on a particular asset class. 2. Focus on quality businesses. Look for companies with strong fundamentals, stable cash flows, and a history of weathering economic downturns. These high-quality businesses are more likely to withstand the impact of rising interest rates and continue to generate returns over the long term. 3. Seek professional advice. Consulting with a financial advisor or investment professional can provide valuable insights and guidance tailored to your specific financial situation. They can help you navigate the changing economic landscape and make informed investment decisions. 4. Consider fixed income investments. As interest rates rise, fixed income investments, such as bonds, can become more attractive. Bonds offer a fixed interest rate and can provide a steady income stream. Investing in government bonds or corporate bonds with good credit ratings can be a safer option during times of economic uncertainty. 5. Keep an eye on inflation. Rising interest rates are often a response to increasing inflation. It is important to monitor inflation trends and adjust your investment strategy accordingly. Consider investing in assets that can provide protection against inflation, such as commodities or inflation-indexed securities. 6. Maintain a long-term perspective. Trying to time the market or predict short-term fluctuations can be challenging and risky. Instead, focus on long-term investing goals and stay disciplined. History has shown that markets tend to recover and generate positive returns over the long term, even in challenging economic environments. I hope you found this video helpful and valuable. If you did, please give it a thumbs up and let me know in the comments.